What really sets the world's greatest investors apart? Is it luck, secret info, or something we can actually learn? In the next few minutes, we'll break down the mindsets and strategies that made investing legends, and how you can use them. We're diving into actionable principles, not vague advice. These are the frameworks and disciplines that built fortunes and shaped modern investing. Let's get right into it. An initial investment of $10,000 in Berkshire Hathaway under Warren Buffett's leadership had an astonishing 19.9% compounded annual return over 60 years. Your investment would be worth approximately $536 million by the end of that period. Known as the Oracle of Omaha, Buffett has built an incredible track record over decades. His core investment idea is simple, yet powerful. He seeks to buy great businesses, companies with a durable competitive advantage, what he famously calls a moat, protecting them from competitors. He aims to acquire these businesses at fair prices, and then, crucially, hold them for the long term, sometimes forever. Buffett emphasizes that you should think like a business owner, deeply understanding the company, not just a trader chasing short-term gains. For example, when Buffett buys Apple, he's not just buying a stock ticker. He's buying a piece of the whole company, its future earnings, and its brand. Because he's focused on the long term, he largely ignores daily price swings and market noise. Instead, he focuses intently on the company's real intrinsic value, its long-term potential, and its ability to generate cash. Buffett's discipline is legendary, a key component of his success. He's incredibly patient. He'll wait years for the right opportunity to present itself, often sitting on a large pile of cash until then. He famously says that the stock market is a device for transferring money from the impatient to the patient. If he can't understand a business and its economics, he simply moves on to something he does understand. He spends most of his time reading company reports, industry analysis, and thinking deeply about investment decisions, not actively trading stocks. Crucially, he doesn't try to time the market, a strategy he believes is ultimately futile. Instead, he focuses on finding wonderful companies with strong fundamentals and lets the power of compounding work its magic over time. So, what's the key lesson we can learn from Warren Buffett? It boils down to patience, unwavering discipline, and a relentless focus on real business value, not just stock prices. That's Buffett's edge, and it's an edge anyone can cultivate with the right mindset and approach. For Stanley Druckenmiller's Duquesne Capital Management, if you had invested $10,000 at the start of its impressive run, generating an average annual return of approximately 30% over 30 years, 1981 to 2010, your investment would have grown to roughly $26 million by the end of that period. He's a master of big, bold moves, a risk-taker who isn't afraid to commit when he sees an opportunity. Druckenmiller makes huge bets, often concentrating his portfolio in his highest conviction ideas. These aren't reckless gambles, though. Druckenmiller's decisions are based on his deep understanding of global trends. He meticulously analyzes interest rates, currencies, and policy shifts across the globe, piecing together a comprehensive view of the economic landscape. His superpower? Flexibility. It's what allows him to navigate the ever-changing markets with such success. He'll reverse a position instantly if the facts change, demonstrating a remarkable lack of ego. He says the best traders admit when they're wrong, fast. Holding on to losing positions is a recipe for disaster in his book. He sizes his bets based on conviction, a strategy that allows him to maximize profits when he's right. Going big when he's sure, demonstrating the courage of his convictions. Scaling back when he's not, protecting his capital and waiting for better opportunities. No ego, just results. His track record speaks for itself, a testament to his disciplined and adaptable approach. His approach: be flexible, adapt quickly, always be willing to change your mind, and don't get attached to your ideas. The market doesn't care about your opinions. For most of us, it's not about making massive bets that could jeopardize our financial well-being, but about staying open-minded, being receptive to new information, and adjusting as new information comes in, constantly refining our understanding of the market. The world changes. Economic conditions shift. New technologies emerge. Your strategy should too, adapting to the new realities and opportunities. When you have conviction, back it up. Don't be afraid to take calculated risks when you believe in your analysis. For Seth Klarman's Baupost Group, if you had invested $10,000 at its inception in 1982, achieving an average annual return of around 20% over 40 years, your investment would have grown to approximately $15 million by the end of that period. Seth Klarman is all about protecting your money first. His mantra: focus on what you can lose, not just what you can make. He buys assets far below their true value, demanding a margin of safety. Klarman is patient. He'll hold cash when nothing's cheap, seeing it as ammo for future bargains. He digs into complex, overlooked areas for hidden value. The takeaway: prioritize risk management, be patient, and only swing when the odds are in your favor. Joel Greenblatt's Gotham Capital Fund achieved an incredible annualized return of approximately 50% gross of fees from 1985 to 1994 over 9 years. At an approximate 50% compounded annual return gross of fees, if you had invested $10,000, your investment would have been worth roughly $384,000. Joel Greenblatt made value investing simple with his magic formula: buy good companies at cheap prices, using a rules-based system. This removes emotion and forces you to look beyond the obvious. He also hunts for special situations, spin-offs, mergers, restructurings, where the market misprices assets. Greenblatt's genius is in finding opportunity where others aren't looking. The lesson: use a disciplined system to overcome bias, and seek value in overlooked places. Sometimes the best opportunities are hiding in plain sight. That's Greenblatt's edge. For Peter Lynch's management of the Fidelity Magellan Fund, if you had invested $10,000 at the start of his 13-year tenure, 1977 to 1990, and achieved his average annual return of 29.2%, your investment would have grown to approximately $280,000 at the end of that period. Peter Lynch, a legendary figure in the world of investing, firmly believed that regular, everyday investors possess a distinct advantage in the stock market. This advantage stems from their ability to gain insights and understanding by investing in what they already know and experience in their daily lives. He found investment ideas in the most unexpected places, often drawing inspiration from everyday life. The products you use regularly in your household, the brands you trust, and the stores you frequently visit and shop at. Lynch's renowned scuttlebutt method involved actively gathering information by talking directly to employees, engaging with customers, and consulting with suppliers. This approach allowed him to gain real-world insight and a deeper understanding of a company's prospects. He categorized companies into distinct groups, including slow growers, which offered stability and consistent returns, fast growers, characterized by rapid expansion and high potential, and turnarounds, companies on the brink of recovery. This categorization helped him to set realistic expectations for each investment. Lynch was always on the hunt for 10-baggers, those rare and exceptional stocks that had the potential to increase tenfold in value. His core lesson is to be observant of your surroundings, cultivate your curiosity, and always do your homework before investing. You don't necessarily need a formal finance degree or specialized training. Instead, simply pay close attention to the world around you, noticing trends and changes in consumer behavior. Great investment ideas are often hiding in plain sight right in front of you, waiting to be discovered. For Howard Marks's funds at Oaktree Capital, if you had invested $10,000 at Oaktree's founding in 1995, it generated generally produced long-term returns net of fees of around 19% per year over 30 years. Your investment would be worth approximately $1,840,000 by the end of that period. Howard Marks is the philosopher of investing, famous for second-level thinking. Don't just ask if a company is good, ask if that's already priced in. Marks urges contrarian thinking: buy when others panic, sell when they're euphoric. He says risk isn't volatility, it's overpaying and losing money permanently. Control risk by being disciplined about price. The lesson: think deeper than the crowd, understand cycles, and invest when the odds are in your favor. That's how Marks stays ahead. For Jim Simon's Renaissance Technologies flagship Medallion Fund, if you had invested $10,000 at the beginning of its remarkable run in 1988, achieving an astounding average annual return of approximately 39% net of fees over 3 decades, for example, until 2018, your investment would have been worth an incredible $195 million by the end of that period. Jim Simons, founder of Renaissance Technologies, is the king of quantitative investing. He uses math and algorithms to spot patterns in mountains of data. No gut feelings, just data-driven decisions. His team of scientists builds models that trade automatically, removing emotion entirely. We can't replicate Rentech, but we can learn from Simon's discipline. The lesson: remove emotion, follow a system, and let evidence guide you. There's more than one path to success. Innovation matters. Simons proves it. There's no single secret to investing, just timeless principles applied in different ways. Whether you're drawn to Buffett's patience, Klarman's caution, or Simons's data-driven approach, it's about discipline and process. Mix and match what fits your style. Which investor's philosophy speaks to you? Let us know in the comments. If you learned something, like, share and subscribe for more investing wisdom. Thanks for watching, and happy investing.